What do the central banks know that maybe you don't know? They know that they are destroying the last vestige of this funny money. They know that it's going to nothing, and all. They also know that they want to stay in power. So why are they doing it? They're accumulating gold so that they retain their purchasing power and they retain their power and their choice and their viability and their freedom. And frankly, that's all the same reasons why you need to have gold and silver.
Lynette Zang is the Chief Market Analyst at ITM Trading, providing invaluable insights into the intricate world of finance. In this video, Zang highlights central banks' record gold accumulation during first quarter of 2023, signifying awareness of fiat currency risks and gold's purchasing power protection. The buying spree from central banks has extended into this year, picking up a record 228 tons of gold in the first quarter, despite easing off rampant levels seen in the second half of last year, according to the quarterly report by the World Gold Council. John Reade, Chief Market Strategist at the World Gold Council, said that whether gold could push higher would depend on whether investors saw signs of a worsening banking crisis, certainty over when the U.S. Federal Reserve would start cutting rates, and a weaker dollar. In light of enduring economic uncertainties, it is prudent to consider the strategic approach that Lynette envisions contemplating the holding of gold and silver. Gold prices are on track to rally to all-time highs in 2024 on the back of tapering interest rates and looming recessionary fears that elevate its role as a safe haven asset. Some analysts are particularly bullish on gold and have called for a target of $2,500 by the end of next year. That's more than 26% higher than current levels. Zang also shares October 2022 shift, indicating buyers and treasuries withdrew, while global finance concerns rise. She predicts tougher times for bonds, ongoing worsens. Interest rates moving higher was a major theme in October as bond investors witnessed surging yields along the entire Treasury curve. The bond yield backup weighed on capital markets as the yields on notable maturities hit historic levels. Now we are presenting you the glimpses of Lynette Zang insights from her recent video with ITM Trading Incorporation. Before we continue to delve into this discussion, we request you to subscribe to our channel and activate the bell icon for timely updates.
What tool do the central banks have when the public confidence is gone? You saw what happened in 2020 where, yeah, they certainly bailed out the corporations and the banks, and they gave a little bit to the public so the public wouldn't realize that they got very little and it was more about them being able to continue to shop. But what just happened recently with this loss of confidence in those banks that went down? And now all of these downgrades, telling you it's a big deal, and these are all signals, and this time isn't different. And that's why global central banks have been accumulating more gold. And to the start of 2023, the first half, they reached an all-time gold buying record. I have enough gold to make sure that I can always pay my property taxes and make sure, because I don't have any wealth that I hold in the system, this is my retirement. This is my future. And this is my opportunity positioning. Get your own strategy together. Its foundation is going to be exactly the same as mine because it's based upon repeatable patterns that happen every time. No, this time is not different. I can't guarantee what's going to happen tomorrow, but if something has happened the same way over 4,800 times and we're doing the same thing, do you really think we're going to get different results? I don't. As we said, the most powerful buyers in treasuries are all bailing at once. This was back in October of 2022, so not a year ago. But we've seen this exodus. So the smart money are not buying the treasuries. And the treasuries are the bedrock, the foundation of the global financial system. Do you see the problem here? Because Fed, foreign governments, commercial banks are all stepping back. And who's stepping into their place? Oh, institutional investors. So there's more pain for bond investors may be in store amid buyer void. So this is not something that just happened. It's something that has been happening. This isn't something that's going to happen into the future. It's just going to get worse in the future. And what you're looking at here is the Fed balance sheet. And you can see how they've been selling off their balance sheet, which is a combination of Treasury securities and mortgage-backed securities. Well, mortgage-backed securities tie into the real estate market. Can you see that the system is falling apart? But how does this happen? Slowly at first, maybe invisibly to most at first, and then very quickly. So you want to be in position before it gets very quickly. And I take this as a really significant sign, because what the Fed is really doing is fighting for their credibility. Because it was a year ago last June when they handed away forward guidance telling Wall Street that they could no longer count on them to tell them the truth.
Lynette Zang points out the recent 30-year bond auction weak demand, indicating ongoing difficulties in managing debt. Yet longer-dated bonds are suffering from weaker demand. Some $23 billion of 30-year bonds drew slimmer demand during an August 10th auction despite offering the highest coupon since 2011. Meanwhile, Zang also highlights Moody's upcoming downgrades for multiple banks, with J.P. Morgan Chase at risk. A Fitch Ratings analyst warned that the U.S. banking industry has inched closer to another source of turbulence, the risk of sweeping rating downgrades on dozens of U.S. banks that could even include the likes of J.P. Morgan Chase. Lynette Zang emphasizes that holding gold and silver is a secure choice during economic crisis. She also suggests that the actions of global central banks, who have been acquiring gold, reinforce its value. Let's get back to interview.
I don't care what they say. What they want you to believe is that this time is different. Keep your wealth in the system. That's their job. They can't be honest with you, because then you might do things that would protect your wealth. You might take your wealth out of the system, making it much harder for them to steal. Don't listen to them, because we just had a 30-year bond auction, a Treasury bond auction, signals weak demand to wrap up the week of big sales. Remember, this quarter they're planning on issuing another $1 trillion worth of debt. And every time they do that, the value of all of the money that's already out there, that fiat money, goes down. It is truly just that simple. They want to make things so complicated, because what they tell us is that if they make it really complicated, nobody questions us. Well, you better start asking the questions, and you better start getting prepared, because we are seeing so many signals that the system is imploding. And in fact, today, we even got notification from Moody's that they're about to downgrade a whole bunch more banks, including J.P. Morgan Chase. And oh, by the way, did you see what happened with Argentina and the overnight surprise devaluation? Okay, when do you want to get ready? You want to get ready in advance. And you're not going to be able to do it if you think that you're going to be able to do it right before. Why? Why would you want to put that much stress on yourself? But week of big sales indicates market is struggling to absorb deals. Uh-oh. Well, all right, we're going to talk about more about what the Federal Reserve is doing with their bond buying. But if they're counting on the market to do it, well, who would that be in the market? Oh, probably institutional investors that are investing your money, because they don't care. They don't really have skin in the game. You have the skin in the game, and you're the one that will eat it in the shorts when this thing blows up. And in the meantime, in order to even sell what they did, you've got the 30-year high yield at sale. I mean, this is telling you that we've got big problems. They have to pay more. And remember, we just had a downgrade from Fitch on U.S. government debt. What does that mean? Well, if you're an individual, you know very well if you're going to borrow money, the lower your credit score, the higher interest you're going to have to pay. Governments are no different. Essentially what they're telling you is that government debt, and I don't care where you are in the world, but certainly in the US, that's the safest thing that you can do. Oh, really? You don't need Moody's or S&P or Fitch to tell you that this is the safest thing you can do. That's why all the global central banks have been buying so much of it. This is the highest yield on a 30-year bond since 2011.
Looking ahead, the trajectory of gold prices appears promising due to factors like tapering interest rates and mounting recession worries, bolstering its safe haven status. Central banks' ongoing gold accumulation underscores its value in times of economic uncertainty. How could integrating gold and silver into your financial approach offer protection amid evolving economic conditions? Share your thoughts in the comment section below. If you find this video informative, don't forget to show your support towards our channel by giving this video a thumbs up and subscribe to our channel, and turn on notifications to stay informed about our latest videos covering more interesting topics. Thank you for watching.